Alright guys, welcome back, and in this video I'm going to show you how you can calculate your lot sizes properly. Alright, this is also very important. You need to know how to calculate all the right lot size you need to use. Alright, so pay attention. Alright, so let's look at some key terms. Okay, so we should look at key terms like pip, we should look at point, we should also look at tick. Okay, so what are they? Okay, these are units of price movements. Okay, everything I've just talked about, the pip, point, tick, are units of price movement. All right, and a point represents the smallest possible price change on the left side of a decimal place, while a tick represents the smallest possible price change on the right side of the decimal place. So that's the difference between a point and a tick. Alright, so now let's talk about a pip. So a pip, also short for percentage in point, okay, it is similar to a tick in that it also represents the smallest change on the right side of a decimal place, but it is a crucial measurement tool in the forex market. All right, so this is what I want you to note. So this is just a simple translation or a simple calculation that you can do. Okay, so 100 pips, this will be equivalent to 1,000 points. Okay, 52 pips will be equal to 520 points. Okay, so the easiest way to calculate, let's say you had your pips right here, let's say you had your 100 pips, okay, and you want to know how many points are in 100 pips. So you just take 100 times 10. So 100 times 10 will give you 1,000 points. Same thing, 52 pips times 100 will give you 520 points, and so on and so on. All right, so as you can see, if you have 3,250 pips, okay, that will be 32,500 points. All right, so let's move on. So now let's talk about key terms. Okay, so we're going to talk about a lot. So forex is commonly traded in specific amounts called lots. Okay, or basically the number of currency units you will buy or sell. So that's what a lot is. All right, so a lot is a unit measuring a transaction amount. All right, so now let's talk about the types of lot sizes. We have 4 different types. Okay, starting us off, we have the standard lot, also known as one lot size. Okay, and this is equal to 100,000 base currency units. Okay, the next we have the mini lot, okay, which is also 0.1 lot size. Okay, and this is equal to 10,000 base currency units. Okay, we also have the micro lot, which is also 0.01. Okay, and this is equal to 1,000 base currency units. Okay, then lastly we have the nano lot, okay, which is 0.001, and this is less than 1,000 base currency units. All right, so now what does base mean? Okay, so base currency is what I mean. Okay, what does base currency mean? All right, so for example, if you for a forex pair like the euro USD, okay, if you have this pair, if it's quoted as the euro USD, all right, so the euro is the base currency and the USD is the code currency in this case. Okay, and if you have a pair and it's quoted like it's quoted as the USD JPY, okay, so the USD is the base currency and the JPY is the code currency. So in other words, so the base currency is what pair they're quoting first, okay, then the code is the second currency they're quoting. Right? All right, so now let's talk about now how to calculate your lot sizes. So as you can see right there, it says how to calculate your lot sizes, and in brackets it says textbook. Okay, by textbook I mean this is how it's usually taught. Okay, or this is how it should be usually done. Okay, but this is not correct most of the time, and that's the reason why I came up with this video. Okay, because you need to know how to calculate your lot sizes properly. All right, so as you can see, it says if you use a one lot size, okay, what that means, okay, if you use a standard lot, okay, what that means is, okay, you're risking $10 per pip. All right, that's what it means. Okay, if you use a standard lot, if you place in a standard lot in your trade, you're risking $10 per pip. If you use a 3 lot size, okay, what that means is you're risking $30 per pip. If you use a 0.2 lot size, okay, what that means is you're risking $2 per pip. Okay, and lastly, if you're using a 0.04 lot size, that means you're risking 40 cents per pip. But like I said, this right here is textbook. This is how it's usually taught, okay, out there. Okay, now let's demonstrate this with an example. And this again, this is textbook. Okay, this is how it's usually taught. Okay, if you have an account size of $1,000, okay, and you only want to risk $100, all right, and let's say you measure your stop loss and it's 20 pips, all right, so the question arises, what lot size will you use? You will use a 0.5 lot size, because remember, 0.5 lot size, what that means is you're risking $5 per pip according to the textbook way. All right, so $5 times 20 to equal to 100. So if this trade right here hits your stop loss, okay, you will lose $100, the same amount you wanted to risk in the first place. Okay, so example 2, so let's say you had an account size of $200, right, and you only wanted to risk $20 of that account on a trade, and you measured your stop loss and it's 40 pips. All right, so question arises, what lot size will you use? So you will use a 0.05 lot size, because a 0.5 lot size will equate or will translate to 50 cents per pip. So 50 cents times 40 will give you $20. So like I said, if this trade hits your stop loss, you will lose only $20, the desired risk you're willing to lose on a trade. Okay, now this right here is the last part, and this is the reason why I actually made this video right here, guys. Okay, the reason I made this video, guys, okay, like you see, it says this is different for different brokers, okay, different prop firms, and the reason is different. Okay, the reason why this textbook way or this usual way may not work, okay, because it's different for different brokers, different prop firms, and the reason for that is because they use different contract sizes. And what that means is, remember when we talked about the standard lot and we say that that's equal to 100,000 units of the base currency, for different brokers or different prop firms, that could be different. They could be measuring it differently. Okay, so if you go in with this textbook way, guys, you might end up losing more than you wanted to risk, or actually if you win, you might end up winning less. That's why it's important for you to know how to calculate your proper lot size. Okay, you want to know how much exactly you're risking on a trade. It's very important, guys. Okay, and as you can see right there, it also says that this can also be different for different assets like forex pairs. Okay, forex pairs. For forex pair like the euro USD, it could be different from a forex pair like the JBP AUD. It could be different. Okay, the contract sizes could be different, guys. Okay, so that's why it's important for you to know how to calculate your lot size. And it's the same thing right here. It says it could be different for cryptocurrencies like Bitcoin, Ethereum. It could be different. It could be different for indices like the US 30 or the NAS 100. Okay, and so on and so on. It could be different for metals like silver and gold. Okay, that's why it is important, guys, for you to know. The reason for that is because different brokers are using different contract sizes and also different assets like forex pairs, cryptocurrencies, indices, metals could be calculated differently. So if you go in with this textbook way, guys, okay, you might end up risking more than you wanted to risk, or actually, if you win, you might end up taking a profit less than you wanted to win. So it's important, okay? All right, so I'm gonna close this presentation right here, and I'm gonna head to the charts. I'm gonna be using my broker, okay, on my phone. I'm gonna use my phone to show you or demonstrate how you can actually calculate your lot size correctly. All right, so I'll see you on the charts. All right, guys, so before we head to the charts, there's something I want to explain, okay? So now let's talk about the formula that we're going to use, okay, to calculate the lot sizes, okay? So we shall use the pending order tool to discover the number, okay, being used to calculate the risk, okay? So we shall be using the pending order tool, okay? But in this video, I'm not going to go about the types of pending orders, okay? I have a full course, okay? A full beginner basic forex trading course that talks about different topics in forex trading. And in one of those lessons, I go about pending orders, okay? So if you want to know more about pending orders, what they are, the types, go ahead and check out my free beginner basic forex trading course. In this lesson, I'm not going to be talking about pending orders, okay? I'm just going to use the pending order tool as an advantage to help me discover the number being used to calculate the risk, okay? All right, so once the number is discovered, we shall always use it to calculate the risk, okay? All right, so now let me talk about the calculation, okay? So when we use the pending order tool, okay, it will display the points, okay? It will also display the lot size, okay, and the risk, okay? So the risk will be in dollars, okay? Like I'll show you later on the chart, okay? The only thing we shall not know, or the only thing we need to discover then, will be the unknown number, okay? So that will be the only missing piece to the puzzle, okay? All right, and as one thing you need to notice, the unknown number will be calculated after several attempts. So we shall keep on changing the digits, or we shall use different figures and numbers until we find, or until we discover this unknown number. All right, so for the example that I'm going to show you on the chart, okay, we shall pretend that we're using an account size of $5,000, okay, and we shall only be risking 1%, okay, which is $50, okay. So this right here is just we should just pretend or assume that the account size that we're having, okay, is 5,000, and we're only risking 1%, which is $50, because remember, when it comes to risk management, okay, you want to risk a certain percentage of your account, okay, preferably 1%, okay. You can go as high as 2%, but advise people to go beyond 2%. Okay, or you can even go below 1%. You can use 0.5%. Okay, but in this example, like I said, we're gonna use 1%, which is $50. Okay, all right. So what will that mean? That means after I go ahead and calculate and find out my unknown number, because I would have calculated, that's step one. As you can see, number one, go ahead and find out your unknown number. So if I find out my unknown number, now if I want to calculate my risk, okay, because remember, in this example I've just said, okay, I will assume my account size is $5,000 and I'll be risking 1%, so that will be $50. So my risk, I already know in this case, okay, will be $50. Okay, I will also know the points. Okay, I'll show you how you can measure the points. Okay, I'll also know the known number because I went ahead and calculated it in step one. Okay, so I'll know the number now. So it's known number. The only missing piece to the puzzle now will be the lot size. Okay, will be the lot size. All right, and with this node, as you can see, same thing. Okay, the lot size will be calculated after several attempts or tries. That means I'll try different numbers and digits, okay, for me to be able to know what lot size to use. Okay, as I'll show you later on the charts. Okay, but one thing to note, okay, I will not be talking about pending orders. Okay, so pending orders, we have the buy stop, sell limit, and so on and so on. I will not be talking about those in this video. If you wanna familiar yourself or know what pending orders are, go ahead and watch my free basic beginner forex trading course. It's on my channel. Okay, one of those lessons, okay, talks about pending orders. Okay, all right, so let me head straight to the chart and I'll see you there.